everybody. Thank you again for joining me this week in our Art of Estate Planning Live. It feels like Thursday has come around really quickly. Now, before I get into today's topic, I just wanted to say firstly, I'm loving the discussion and collaboration and knowledge sharing that is going on in the group. Thank you so much for everybody who is contributing, and special mention to a few people who've had some really interesting posts this last week. So Megan, your life tenancy question was really got the brain juices flowing. Special mention to Emily, Jacinta, Josh, Harry, and also Amanda. Thank you guys. Love that you're asking questions, putting practical issues that we're all facing every day in our practices up on there, and that everybody is coming together, bringing our own insights from our different industry and profession to try and find a solution. So I'm loving it. Thank you. Now, today's topic is focusing on the differences between family trusts and testamentary trusts from a taxation perspective. And big thank you to Adele for suggesting this topic. And Adele, yes, thank you for being here. So what I thought I wanted to do is focus on some of the practical tax differences in the life cycle of a testamentary trust. So a lot of the stuff we focused on is how do you set them up, how do you structure them, what actually happens when your client dies and we have to administer the structure. So as advisors, what are the different tax consequences and the different events that could come up in the life cycle of a testamentary trust, and how is it taxed differently to a family trust. Now, I do have a handout that I will put up with the video recording afterwards, so you don't have to take detailed notes. And there's also some really good notes from Adele as well in the comments. So Adele's done an awesome flow chart about Division 6 taxation consequences, so 95 and 97 of the Tax Act. So I'm not going to go into that. What I wanted to do is sort of walk through a couple of different events, so focusing on income tax and capital gains tax. And I can see the questions here. So if you have any questions as we go through, just pop them up in the question box. I'll try to answer them. If I can't think of the relevant tax section on the spot, I will come back to you afterwards, okay? So, thought it would be good to do the good old butcher's paper, but I have got a nice neat summary for you afterwards. But for demonstration purposes, I basically wanted to walk through some of the tax issues that come up from an income tax perspective, look at what happens for a family trust, and then how's that treated for the testamentary trust. Okay, income tax treatment under Division 6. Basically, so that's this idea that a beneficiary is taxed on their share of the income of the trust. So basically their Section 95 taxable income is worked out by the proportionate share of the Section 97 income. It's the same. The Division 6 of the Tax Act principles apply the same to the family trust and the testamentary trust. So, I mean, we could spend a whole hour working through those provisions and the impact of the Bamford decision. So I won't do that today. And a shout out to Adele for her really cool flow chart about that. But basically, when we're looking at the trusts, they're the same. They are both discretionary trusts. Okay, so that also leads us to this idea of a tax file number. Do they both need to get a tax file number? Yes. And when you apply for the tax file number for the testamentary trust, you choose the option of it being a discretionary trust, because at its core, both of these trusts are just discretionary trusts. Okay, they just have assets sourced from different places. So they both need a tax file number, and I get asked this all the time. The testamentary trust does need a different tax file number to the deceased estate. So basically, once the deceased estate, which is in itself a trust, but like a bare trust or a fixed trust, once the deceased estate ends and the administration is wound up, that is when you then establish the testamentary trust and apply for the tax file number. Now, a big difference following on from the treatment under Division 6 is distributions of income to minors. This is the big one. This is why testamentary trusts are so powerful, because you cannot distribute more than $416 to a minor from a family trust. But the testamentary trust, you get accepted trust income under 102 AG 2A of the 1936 Act. And that means you can distribute income to minors from the testamentary trust as if they are adults. So they get their full marginal tax rate and then, the full tax-free threshold of, I think that's about $18,200 plus the low income tax offset, blah, blah, blah. So that gets them to about $20,000 and then marginal rates from there. So to me, that is the big advantage of using testamentary trust and the big distinction there, income to minors. Now, you have to be careful. There are a number of integrity provisions around the income that can be contributed to the trust. So it has to be sourced from like a will or a codicil or an intestate estate, okay? You can't get accepted trust income on assets contributed to a testamentary trust that were not sourced from the estate unless the trustee paid market value consideration and it is not part of a scheme or an arrangement to get accepted trust income. So there's been a couple of cases. The big one is the first case, FURSE, and then there's been a few private rulings. So you can use the original sourced assets and sell them or reinvest the proceeds and change the nature of those assets. You can even, in the first case, I think the trust had a capital of $1 and then they used that dollar and borrowed more to buy units in a trust, which was a related trust, but they were held to be dealing at arm's length even though they were related parties, and all of the income earned from the units which they borrowed to acquire was accepted trust income. So they're not super strict, but you have to be careful. You can't just be throwing in all of the other assets into a testamentary trust and get accepted trust income unless you're paying arm's length consideration for them and dealing at arm's length. And if you don't have assets that are earning income that are eligible for accepted trust income, so say you haven't followed those rules and you've tipped in like an investment property or listed shares and you didn't pay arm's length consideration, then the beneficiaries get taxed on the proportionate share of all of the income earned. So you can't say, oh, well, we'll stream the income to the minors that was accepted trust income and the non-accepted trust income to adults. Doesn't work that way. They'll get taxed proportionately and probably exceed their $416 limit. So just be careful with this. There are some strict integrity provisions, and it was also flagged in the 2018 federal budget as an area where they were going to crack down. Now, nothing has happened. They haven't expanded on those current integrity rules, but just be aware that this is something that they're looking at. And no wonder, right? Because the ability to get accepted trust income, these rules are allowing wealthy families to stay wealthy for generations because they're not paying anywhere near as much tax as people who don't have access to it. So the number one difference, accepted trust income, you can have tax-free distributions to minors from the testamentary trust. You can only have $416 maximum from the family trust. What about accumulating income? Again, another distinction. So generally speaking, if you accumulate income in the family trust, it will be taxed at the top marginal rate in the hands of the trustee under section 99A. Now, for the testamentary trust, the commissioner has discretion under 99A2 to actually apply section 99 instead and tax accumulated income from the testamentary trust, so income earned from the estate of a deceased person at the beneficiary's marginal rates. So much better outcome. You can accumulate income in a testamentary trust. In a family trust, you cannot. So I think you probably already know this, but trusts are flow-through vehicles for tax purposes. So the general concept under Division 6 is that income has to be distributed, all of the income has to be distributed by the end of the financial year, and the income is taxed in that beneficiary's tax return, not like a company. So it's not like where the company pays tax and then top-up tax is paid. Okay, so they are flow-through vehicles for tax purposes, which is why, the family trusts are nice, nimble trading structures, but they're not good for accumulating retained profits and income because of section 99A and it being taxed in the hands of the trustee. But the testamentary trusts, again, get an exemption. I'm just going to check the question here. Lauren, so distributions from other trusts cannot be distributed onto the kids, is that right? Yeah, look, I think that is, so what you're talking about there is you've got, say, a family trust, distributing to the testamentary trust and then distributing to the minors. I think, I'll have to check that, Lauren, but I think that could be caught. Let me check. I feel like there's a ruling on that. Let me check. I'll come back to you, Lauren. I'll put it in the comments afterwards, but I think that's not income sourced from a deceased estate and therefore won't be eligible. But really good question. Okay, family trust elections. We know a family trust has to make a family trust election, so that's not mandatory. Basically, if you want to carry forward losses, or if a beneficiary is receiving franked dividends from all sources, but including this trust, that are more than $5,000, then to access that, then you need to have a family trust election. And what a family trust election does is, once it's made, you choose a test individual, and then only people in that test individual's extended family group can receive distributions. And if you pay a distribution to someone outside of that family group, then family trust distribution tax is payable, which is at the highest marginal rate. So you would think twice about making a family trust election. Don't just do it by default. The family group is reasonably large, but when you're looking at multiple generations having a trust, it can really limit who can actually benefit. So you only make one if you have to. Family trusts have to, if they want to access the carried forward losses and dividends. Testamentary trusts are the same. There was a whisper, I think back when Dutton was treasurer, he had an announcement that testamentary trusts would be exempt from having to make the family trust election, but that was never legislated, and they currently do. We've talked about the tax file number. The last one is streaming dividends and capital gains. So streaming means making particular beneficiaries entitled to particular classes of income. So for instance, capital gains, you may know that individuals and trusts can access the 50% 12-month discount. So if they've held an asset for 12 months, they can discount their gain by half, but companies cannot. So you would not want a capital gain to go to a company. You would try to, for instance, if you had an individual, maybe allocate the capital gain to them. But there's franked dividends, you might want to allocate that to the company. Or what a lot of people do is allocate up to like 90,000 to husband and wife, and then the balance to a company so that they cap the tax and no one's paying more than 30-something%. So you can, but prior to 2010, this was willy-nilly. People would stream like primary production income, interest, all different types of income. And then after the Banford decision and the update to Division 6, they brought in the rules and said you can only stream franked dividends and capital gains. And you can only do that if your trust deed expressly allows the trustee. Now, that was introduced as interim legislation. It was all meant to be kind of like updated and introduced as a hurry. Now it's about 9 years later, nothing's happened, it's still the law. So you need in your trust deed for the testamentary trust and the family trust, so the same powers. So basically it's the same, there's no difference there. And this is why testamentary trusts, it's really important to craft your testamentary trusts like you would a family trust. You need all of those extensive tax powers, the definitions about distributable income, and the powers for the trustee relating to income are really critical, because Division 6 is the same, streaming is the same. You need the exact same extensive powers in there. Gone are the days where the testamentary trust can just have couple of pages of powers and that's it. It needs to be comprehensive. So in terms of income, I think those are the main points. If there's anything else, let me know. So let's move on over to capital gains tax treatment. And particularly, what is the capital gains tax? Okay, I'm back. Hopefully that didn't disrupt things too much. Okay, so capital gains tax on, firstly, how do you get assets into the trust? So if it was a distribution into the testamentary trust by the will, it will be CGT and stamp duty free. So this is why testamentary trusts are an amazing tax planning tool, because you can move assets into a trust environment. You get the asset protection, you get the tax streaming, you even get the accepted trust income treatment, no tax and no stamp duty. So for a lot of clients, we use the estate plan and the will as an awesome business restructuring tool. Yes, you have to wait for somebody to die, but you might as well, if someone's going to die, you might as well maximize the structuring opportunities, because those assets have to be transferred anyway. If you're transferring taxable assets and stamp dutyable property into a family trust, no exemption unless you're relying on a specific exemption. So a lot of the time, we have to manage the transaction costs of getting the assets into the trust. What about getting assets out of the trust? So if you're doing a capital distribution of a taxable asset out of the trust to a beneficiary, so listed shares, we won't deal with the stamp duty, just the tax. So you've got listed shares with latent capital gains, and we want to distribute them from the trustee of the trust to a beneficiary. There's my notes here. You're going to have CGT event E5 or maybe E7 or maybe E1 apply on that distribution out of the trust from the family trust for a discretionary trust. if they're already absolutely entitled and it speaks different. But if we're talking about just a normal family discretionary trust, you're going to have tax consequences on that. Versus the testamentary trust, we get the exemption under 128.15 of the 97 Act. Now that says an asset passing from the legal personal representative to a beneficiary is exempt. So those words are not clear. Legal personal representative to a beneficiary. And on its face, you would think, well, I don't know if that includes to the trustee of a testamentary trust to a beneficiary. Is legal personal representative and trustee of a testamentary trust the same? We are saved by PSLA 2003, is it 15? 12, number 12, which says the trustee of the testamentary trust should be treated the same as the legal personal representative. And the ATO will not recognise a taxing point for assets transferred under a will until they leave the hands of the ultimate beneficiary. So that means if you look at our lifestyle of administering the estate and the testamentary trust, from the deceased to the legal personal representative, exempt. From the legal personal representative to the trustee of the testamentary trust, exempt. And then from the trustee of the testamentary trust to the beneficiary, exempt. And then when that beneficiary disposes of it, that is when they will have their taxable gain. So getting assets into and out of the testamentary trust is exempt compared with the family trust. So this is a big one too. If you actually, this is why I say, if in doubt, set up the testamentary trust, because you get the asset protection. You have all of the accepted trust income. There's no question about that. You don't have the issues of contributing assets into a testamentary trust after the fact. And if they decide and they get advice and it's prudent advice and they make a sensible decision not to hold those assets in the trust, you can get them out of the trust. Stamp duty depends state by state. I know in Queensland sometimes there can be issues with that. I don't know if anyone's done a transfer like that lately and can share their insights, but from a tax perspective, it's all exempt. What happens when the vesting date passes? This was always an area of uncertainty. I remember sitting around a tax training meeting at McCullough Robertson years ago, and all the partners were having a big debate about what actually happened when the vesting date passed, because does the trust end? Do you trigger E5? Is it E1, a new trust? Like, what goes on? And so the ATO brought out last year TR 2018 6, I think. Yeah, number 6. So which applies to the testamentary trust and the family trust. And basically they said, just by the vesting date passing, you don't get a new trust, so that doesn't trigger E1. The default beneficiaries don't become absolutely entitled, so that doesn't trigger E5. And unless you actually close down the trust and transfer the assets, there's no E7. So all that happens when the vesting date passes is that the default capital and income beneficiaries their entitlements become fixed. So it goes from a discretionary trust to a fixed trust. So no longer does the trustee have discretion to allocate the income and capital at their discretion between the beneficiaries. They have to allocate it to the default beneficiaries in their proportions set out in the deed. But the trust continues and it is the same trust. So that's a relief, because nothing actually happens other than the entitlements change of the beneficiaries, but you don't trigger a tax event. You then have to decide, well, does this trust just keep on going and going with fixed entitlements? Obviously, you don't have the same asset protection and tax flexibility as you once had. So you can then decide to wind up the trust and distribute, or keep it going. Now, there will ultimately be tax consequences because you go from the vesting date passing to making a capital distribution. But as we saw for the testamentary trust, it's exempt. Okay, the last one, disposing of the principal place of residence. So I personally do not advocate people to put their principal place of residence into the testamentary trust unless they need the asset protection. So unless the surviving spouse is high risk, or if both spouses are passing away, you know, in that circumstances, I think it's okay because where it's expected that the principal place of residence will convert to an investment asset and no longer be it. But it's not fatal if you put a family home into a testamentary trust. If we rewind a step, and there was a case that came through like a few weeks ago where this was tested again, putting your home into a family trust and having one or more of the beneficiaries using it as their principal place of residence, it won't be exempt. When that trustee sells the home, not exempt, you'll pay tax. You don't get the principal place of residence capital gains tax exemption. But the testamentary trust has much more favourable treatment. So, if the property was acquired after 1985 and it was the principal place of residence of the deceased, the trustee, and it goes into the testamentary trust, the trustee can disregard the exemption under, it's 118-195, under a few circumstances. Firstly, they've got 2 years to sell it. If they sell it within 2 years, doesn't matter who's living in the house or what's going on with it, as long as it wasn't used for income producing purposes, then the gain is disregarded and you get the principal place of residence exemption. If they don't sell it for 2 years, then it is still exempt if A, the spouse of the deceased lives in the house and uses it as their principal place of residence, and then when it's ultimately sold, the trustee can exempt the gain. Or B, if the beneficiary who lives in the house after the deceased died has a right to reside and occupy the property in the will. So this is why it's a good idea if you, for instance, if we decide to put the property into the testamentary trust and say we think one of the adult children are going to occupy it as their home, write an express right to occupy the home into the will so that you can continue to access the capital gains tax exemption if it's ultimately disposed. And I also include a general power to the trustee for them to grant a right to occupy that home or any future home to any of their beneficiaries. And that should still satisfy the exemption in 118-195. So, as we can see from a capital gains tax perspective, the testamentary trust just wins hands down. It has a much more favourable tax treatment from a capital gains tax perspective than the family trust. And from an income tax perspective, that ability to get accepted trust income to minors and to accumulate income is just a game changer. So I hope that elaborates on the difference between the two. I had a question yesterday come up in a webinar and someone said, well, why can't we just have a simple will and then contribute the assets into a family trust after someone dies rather than, you know, spending the money on a testamentary trust now? So I really hope this demonstrates why that is not a good idea. You won't get any tax exemptions or stamp duty exemptions on contributing the assets into that family trust after death. You're probably not going to satisfy 102AG, so you won't get the ability to stream to minors, you won't be able to accumulate income. And the gift, so the actual transfer of assets into the family trust, because that usually has to happen by way of like a gift or something by the beneficiary, And if you're putting it into the family trust, chances are that you're a at-risk beneficiary because you don't want to own it on your own. And that is going to be subject to the 4.5-year clawback period, and the trust has to pay you value for it. If they don't pay you value, it's unlimited. Whereas if it goes from the deceased through their will to the testamentary trust, there is no clawback. So if in doubt, set up the testamentary trust, leave the assets to the testamentary trust. It's just a no-brainer in my opinion. Now, we are right on the half hour. I hope that's a good summary. I'll share this with Adele's permission. We'll also share the Division 6A flow chart as well, and I'll put my summary up. And if you've got any more questions, let me know. Lauren, I'll chase down that ruling that I'm trying to remember about distributions from a family trust to a post-death trust. One more thing, next Thursday we won't be having a live because I'll be at the Death and Taxes conference at the Gold Coast. There's still tickets if you're interested in coming. Come and have a beautiful, warm escape from the southern winter up here. So we won't have a live next week, but I'll be updating everybody about anything cool I learn at the conference, and I will see you all in the next fortnight. Thank you for watching.